Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca, Canada's authority on home ownership. Welcome back to the show, Ross.
And thanks for having me back on, Jim.
Ross, today the Bank of Canada announced rates would remain unchanged, even though it warned of an escalating housing market. John in Calgary asked us, realtors in Calgary are claiming house prices rose 5%, but two families we know bought in the last 2 months homes they could not have afforded last year. I guess that means the price had gone down. Is this the house price illusion Ross often quotes?
Perfect. There's a perfect. I think, for about a year now, we've told everybody, watch the Calgary Real Estate Board, CREB. You watch their stats, because the Calgary Real Estate Board was a housing market that was functioning at a point where all the myths about home buying could be debunked. Not only does that real estate board offer the most robust set of data daily that Canadians could access for any real estate board, but they don't even realize themselves what they're releasing. And I think that's what this fellow's probably is touching upon. Look, today the Bank of Canada announced that they were going to hold rates. Now, if there is anybody out there who believes they were going to announce a rate increase today or a rate decrease today, I don't know what they're smoking. Even if it's legal in Canada now. The bank is not going to change rates, okay? The bank really doesn't have a lot of power in how they change rates. The bank's power exists before those who determine the rate, or the functions that determine the rate, move the rates that the bank has to deal with. So the Bank of Canada can attempt to control inflation. It can attempt to control the economy. It can attempt to control many things, but it doesn't actually set the rates, because the rates are measured on risk. Now, the bank doesn't say this. I don't know why they don't say it. Let's just be honest with the Canadian public. The bond rating agencies, international bond rating agencies, like Moody's for say, if they downgrade Canada's credit risk, you are going to see an increase in mortgage rates. That's as simply how it goes. Bond traders, the people who buy Canadian bonds, simply won't buy Canadian bonds if they view the risk to reward is too high. In other words, there's too much risk and not enough reward. Historically, as far as we measure forecast for interest mortgage rates, we're always forecasting. We always look at where the bond rating agencies believe Canadian house prices are, or where they're going to be going. The reason why we can borrow money this cheaply today is because the bond rating agencies believe the Kool-Aid that the Canadian Real Estate Association sells every month, which Canadian home buyers believe every month, which reinforces the bond rating agency's decision. In Calgary, John, this is what happened. You actually gave the answer yourself in your question, except that answer hasn't been presented to you the way I'm going to present it to you right now. The average home buyer in Canada is approved by the government of Canada through its policies to borrow money, mortgage money. Between last year at this time and this year at this time, meaning January, February, March, home buyers were approved by the government an extra 10%. The Canadian government has approved home buyers to take on a 10% larger mortgage than when they were approved to take on last year. So listen, they have approved people. They have authorized you to take a mortgage 10% bigger than the one they authorized you to take out last year. Now you have to remember, the money they're authorizing last year and this year is so far below the risk threshold that existed up until 2016, that there's not a single home buyer in Canada, in a historical perspective, that exposes themselves to any kind of a risk by simply borrowing the maximum amount of money the government authorizes them to borrow for a mortgage. That means a young couple in Calgary could go out and buy the exact same home this year than they were going to purchase last year and have a smaller monthly mortgage payment owning it. It's going to be so small that there probably has not been a 5-year cohort of home buyers in the last 50 years that have ever spent that small amount of their income each month on the mortgage that Canadian politicians are allowing them to hold. These home buyers see this and they say, wait a second, we can get an extra 10% more than what we could get last year. Oh, but our payment is only this small. Wow, that's less of our income than what our parents spent when they bought their house each month. So what they do instead is they go out and buy a 10% more expensive home. They buy maybe a house that is 10% larger, maybe a home that is one category above what they were able to buy. Maybe they could only buy a townhome last year, and now they can afford, the government will approve them to buy a semi-detached. They will buy the semi-detached. When they talk to their parents, and they tell their parents that they're only spending about 28% of their income on their house, the parents laugh at them because the parents had a mortgage that was 36% of their income. Do you hear what's going on, John? Home buyers, the exact same family, earning the exact same amount of money in the spring of 2021, are able to buy a house that costs 10% more than the house they were able to buy last year at this time. And the government endorses this purchase. So what do? It only makes rational common sense that you go and you buy a house that's 10% better, whether that's 10% bigger, whether that's a 10% different kind of home, whether that's a 10% better neighborhood. You simply buy a house that's 10% bigger. Now, you also have to understand, John, that the Calgary Real Estate Board said the average price only went up 5%. So here we have your friends spending 10% more, but prices only went up 5%. What does that mean? What that means is the net gain for these home buyers is on the positive. In other words, a house that they're buying is worth less today than what it was worth last year at this time. It's simple math. What your friends have been able to do was to buy a better house at a lower price than they were able to buy last year. They win. The Calgary Real Estate Board also wins because they get to claim the average price increased 5%. This is one of the few examples in the rarest of MLS systems where you get to see this live in real terms. Now, I'll tell you this, John. If you measured house prices, the average, if you measured the TSX 60 Composite Index, the same way that the Canadian Real Estate Association measures average house price, using identical methodologies, the TSX 60, which went up 4.5% last month, would have gone up over 50%. So had the Stockbrokers Association of Canada used the same methodology that the Canadian Real Estate Association and your local MLS systems use to measure house prices, those stockbrokers would be claiming, out there bragging, that stock prices, the TSX 60, increased over 50%. There is a function of a housing market that's called the laddering effect. And if you apply the laddering effect to the stock market, the TSX 60, the TSX 60 would have been up over 50% in last month because the laddering effect would have taken place on each day of the month. The laddering effect in the housing market only appears once every month, once a month, at the end of the month when the new sales are reported. What the laddering effect is this. You take the houses that are most in demand in a given month, and you measure them more than the houses that are in lesser demand. You ladder it up. The next month, you recalculate. You look for the houses that have increased the most or have the most demand in that month, and you discount the houses that were in lesser demand. You ladder up again. The next month, you repeat the process. Each month, the ladder effect causes the average house price to take a step up. Depending how strong the demand is on certain categories of homes in certain municipalities in certain months, the amount of the ladder effect changes. And in some months, it's substantially higher than what it is in other months. But each month, the laddering effect applies. So imagine the stock market. If the bank stock components of the TSX 60 went up, 10% in a month, where all the other components went up 2%, for the sake of the argument, what the stockbrokers would do is they would count those bank stocks double than what they counted them the previous month. But they wouldn't tell anybody. They would simply say at the end of the month, the TSX, the TSX 60 has gone up 2% today. The next day, Brookfield's gone up. We're going to count it 4 times. We're going to count all the other stocks less. It's laddered up another 2% today. The next day at 1%. The next day 2%. The next day 3%. Then, it's back to 1. And this goes on over the course of the month. And at the end of the month, they stand back and say, guess what? The TSX 60 increased 50% this month. They didn't tell you how they got to that number, because 31 times, if it's a month with 31 months, or 31 days, 31 times in that month, they use the laddering effect. Organized real estate only gets to use the laddering effect 12 months of a year. Your local MLS gets to use the laddering effect in the local MLS 12 months of the year. Your local city, whose stats appear in some MLS numbers somewhere, they only get to use that laddering effect 12 times a year. Your local neighborhood gets to use that laddering effect only 12 times a year. Each category of home, meaning price points, categories of homes are defined by how the buyers are viewing a housing market, how they're interacting with a housing market. They only get to change 12 times a year. But what's beautiful about the laddering effect is that it keeps building, and the amount of effect increases over time. The longer that the upward slope of the ladder works, the more price change takes place, until the ladder can no longer be supported under any measures. Now imagine, stockbrokers wonder why they have such a hard time convincing Canadians to invest in the stock market but then stockbrokers themselves say, it's because house prices are going up so rapidly that people will be crazy not to buy a house versus buying the stock market. Except they don't understand how house prices rise, and average house price rises, and why it's different from the TSX 60. The TSX 60 does not have any laddering effect. Average house price is 100% supported by the laddering effect. It's funny, Jim. Early, I heard, in my life, I heard about the laddering effect as applied to dividend stocks or GICs. You buy a GIC, you stagger their maturity dates, and you get an average gain on your GIC that because you spread out the risk over a longer period of time. You ladder your stock purchases so that you keep rebuying with your dividends. And to me, this is just common sense, guys. It's common sense to me because this is how MLS systems are designed to function. The laddering effect controls everything that you know about house prices. And John in Calgary has just showed you why. Home buyers were approved to purchase homes 10% more expensive in Calgary in the spring of in January and February of 2021 than they were January, February of 2020. The government of Canada approved them, authorized them. The infrastructure directed them to buy homes that were 10% more expensive. They bought those homes. They got a great deal because they couldn't have bought those homes last year for the same price they paid for them this year. And the Calgary Real Estate Board smiles. Even though house prices are dropping, the Calgary Real Estate Board claims house prices rose 5%. You're seeing the laddering effect in real time.
We'll have more with Ross Kay right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Ross Kay. We have another question here from Sue in Vancouver. She said, last week we saw the show's headline included a mortgage reduction pay down that was cut from the show. Well, actually, Sue, we actually didn't get to that, but the process between headlines and what goes to air is kind of complicated. But anyway, Sue in Vancouver asks, we listened to last week's show and wanted to know how to pay off 45% of your mortgage in 245 days. Well, Ross, how do you do that?
You're such a pro, Jim. You're such a pro. I don't know why you're not on the news. Let's see. Yeah. So what you're looking at there, folks, is the modern way of approaching home ownership. So, and these comments will be self-serving, so I'm not going to pretend that they're not. When we launched the Wealthy Homeowner, we launched it for a series of reasons. But one of the reasons is because we're able to time housing markets with such accuracy. In other words, we know what's happening in the housing market months before it happens. That builds such a great degree of lead time, of risk, that it is something that we believe people shouldn't pass up. Because there are aspects of the economy that are triggered by the housing market. It's specifically triggered by the average selling price as reported by the Canadian Real Estate Association, which any longtime listener will understand. We've always stated it has nothing to do with house prices. This creates opportunities for people. Now, this is not guessing at something. This is simply following a set of rules that remained unchanged for the last 40 years, and you go back to 1980 and you follow through till today, and if you followed this set of the rules, you never made a mistake. Now, the reason you didn't make a mistake was it's impossible to make a mistake because the housing market does not turn on a dime. As everybody found out when the pandemic reopened, when the lockdown opened, you found out that the housing market didn't turn on a dime. I will also tell you that the housing market in some markets right now is already turning again. It signaled that turn months ago. You just can't read it. So what that means is when you have this kind of a lead time, it provides opportunities. Okay? Now, we also say that these opportunities shouldn't listen to anything that I say here on House Street and believe it at face value. You shouldn't. You should go out there and seek your own answers. And it's the same in this. In this case, we employed a strategy in May of 2020, already now into the lockdown, where we saw an opportunity based on common herd reactions that provided an opportunity to pay down your mortgage. As long as you consulted your accountant before you took action, as long as you consulted your financial advisor before you took action, fee-based financial advisor, and as long as you maybe even reached out to your lawyer and confirmed with your lawyer that there was nothing fishy going on with this recommendation. 245 days later, you could have paid off 45% of your mortgage. What this means is that, let's say that you had a TFSA and you had money in a TFSA, and someone told you, I don't know, back in May the 29th on House Street, that Canadian bank stocks were going to increase in value in the short term because the housing market, which we didn't say on the House Street, as we didn't give you the full story about this, but go back and listen, May the 29th, you're going to hear where we say what happened with bank stocks, banks, Canadians don't understand. Well, if you did understand, you could have simply, whatever bank held your mortgage, you could have simply purchased bank stock And then 245 days later, you could have cashed that bank stock out. Hey, prices are still going up. You could have held on to it for all we care. You just simply set a target, and once you get to that target, you sell it. Once you sell it, you pay off your mortgage. It's as simple as that. Now remember, you've got an accountant, you've got a financial advisor, and maybe your lawyer overseeing the whole process. So you've got 3 levels of protection there. The advice that we're providing is advice that was never before provided to people. Because we can tell, because most people are afraid to do these things because they don't know where the house price is going to be headed. In other words, oh, my house could drop in value 20% tomorrow. Never going to happen, folks. Okay? It's not how it works. You have months and months of advance notice of negative house price growth, period. That blip that you saw last April where housing prices dropped, that was not a blip. That was just a misread of the data. You had to look at the composition of sales mix. Remember the last section, we talk about how the ladder effect works. Well, the ladder effect is based on the composition of buyers active in a month. Okay, that's what it's based on. If you're able to measure the composition of buyers, you know what's going to happen in months to follow. Because that pattern has repeated itself over and over and over again, hundreds of times since 1980. So what I'm saying is this. If you own your home under the traditional ownership model, which may have been prudent when your mortgage rate was 10%, then this opportunity wouldn't exist. Because back then, no one said, talk to your accountant, talk to your lawyer, talk to your financial advisor. Back then, financial advisors had targeted a staggering 12% compound annual growth rate. That's what I was told. So imagine me as a young guy, 28 years old, and my financial advisor, starting to sell real estate. My financial advisor tells me I have to get 12% compound annual growth rate on my money to be able to retire when I'm 60. That was the advice that was universal in that time. It appears in every single financial book that exists from that time. Well, of course, now, here I'm at 60, and well, you mean, man, that was the craziest advice I'd ever heard. Because the advice is what's called average advice. It's like average house prices. It's made for the average person. The average person won't put in the effort. Look, you can't time a housing market as a home buyer if you're not willing to put in the effort. You're better just to go ahead and listen to your local realtor and do whatever they tell you. Because at least then you're going to own a home. But don't look to get the extra $1, $2, $3, $400,000 in wealth by the time you're 60, because you're not going to put into the effort. If you put in the effort in May of 2020, you could have paid off 45% of your mortgage 245 days later. This isn't debatable. If you had followed this same system from 1980 through till today, using the exact same rules, you would have always paid down your mortgage quicker. Not a single time, not once following these rules, would you have ever taken longer to pay off your mortgage. And that's how you do it. You use intelligence, not your own, I'm saying market intelligence, and then you use a team of professionals who you pay to protect you. Tell your accountant not to listen to the advice we give you, but for your accountant to do a critical assessment on that advice. Don't tell your financial advisor to listen to us. Ask your financial advisor to do a critical assessment of what we're telling you. Don't listen to what we're telling you. Ask your lawyer what avenues you have if the information we were giving you was incorrect, if it was fraudulently produced. Ask them. This is the most beautiful thing about being an advisor, home ownership advisor, versus being a real estate salesperson. We encourage you to seek out professional advice to critique what we're saying. We want you to challenge us at every point. We want you to be proactive. Proactive would have paid off 45% of your mortgage in 245 days, following the same set of rules that you could have used from 1980 through till today.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a lot of times you've mentioned how housing policies should never be changed outside of the cyclical trough all housing markets experience. Mary and Markham asks, we are frustrated by the market. We listen to the CMHC, politicians, and bankers all claiming that changes they enact will reduce the price of housing. Of course, what we actually see is the total opposite. Why does Ross not show CMHC how their policies are wrong and why they always have unintended consequences to my family?
Okay, so Marion Markham, here's my answer. A gardener, an experienced gardener, they plant a plant, and in order to get that plant to get as tall as possible, they prune leaves off that plant. They don't wait for nature to drop those leaves off the bottom of the plant. They actually go in and they prune the weakest part of the plant away so that the stronger part of the plant can grow. And this is our way of explaining how policy changes enacted by all these parties work and why you need to make these changes before you plant your next crop, not through attempting to prune the plant, which only makes it grow taller, or in the Canadian housing market's case, the average selling price reported by your local MLS system being stated as going taller. When policymakers prune the buyers from the buyer mix, they inevitably prune the weakest buyers in the market. When you prune the weakest buyers from the market, that means you are pruning the buyers of the cheapest homes. You're not only pruning the buyers of the cheapest homes, but you are limiting the ability of families who already own homes to trade up into more expensive homes if their finances are not in the best of condition. You prune those buyers out of the market as well. So what you end up with through this pruning process, you end up with periods of time, mid-cycle, where, first of all, you lop off the bottom lead, first-time buyers. You lop off the buyers with the lowest financial position from buying a home. When you remove those buyers, obviously, those cheapest homes don't sell. The average price goes up. Then when you go back in with your snippers again, and you prune a little harder, and you prune with the next cutting, trade-up buyers from the market, leaving only the most financially empowered trade-up buyers to move up the property ladder. Those property buyers take a larger step. That larger step simply gets recorded as a larger increase in the average price. Then when you take more policies and you go back in and you prune more first-time buyers, the strength that you've got going at the top intensifies once again because all of the energy that is required to go into the plant is now focused at the top because you've made that final cut. That final cut, folks, happened on July the 1st, 2020, when CMHC lowered the maximum gross debt service ratio that they would qualify first-time home buyers to buy a home at. Not only did they do that, but they increased the minimum credit score required for CMHC approval from 600 to 680. A singular increase that is a Canadian record. They pruned so aggressively in 2016, 2017, and again in 2020, all because they believed that they were cutting the top of the plant off. They didn't realize all they were doing was pruning it. And with each successive prune that they did, more energy went into growth instead of making a bushier plant, taller and taller and taller. Well, folks, like plants, the home trading market can only get so tall before the stock can no longer support the plant. And that's what's called a housing bubble deflating, where the plant is no longer supported because there's the fewest number of first-time buyers entering the market, and they no longer can sustain the weight that's at the top. What would you think, folks, would be recorded on an average price at that moment in time, at that precise month or 2-month period, depending how the organized real estate MLS systems fudge their numbers from month to month? What sales are we going to put into the next month? Which sales are we going to hold back from the previous month? So we'll just give that 2-month period. What do you think happens in that 2-month period when all that pruning takes place, when the plant is so weak at the bottom because there's not enough first-time buyers holding it up, that all of that growth was focused at the top? What do you think it happened at the very last moment in time? Do you think that the average price would increase at its highest year-over-year gain ever? If that was your answer, you'd be right. And if you're right and you're looking to buy a home, you're the type of people that we want to talk to.
Ross, I also just saw a headline today in the Toronto Star saying people are getting multiple offers on their condos again in downtown Toronto, and they're getting more than the asking price. Is this just something being pushed by real estate again to encourage more sales where perhaps they don't really exist?
Hey, Jim, you're going onto a car lot. You're looking to buy a Toyota Corolla, Toyota Camry, and you see a sign over there that says, this Lexus 300 is the exact same price as this Camry. There's 10 people standing around that Lexus because they see the price and they say, holy cow, this is an unbelievable deal. We could buy this Lexus for the same price as we could buy this Camry. They all talk to their salesperson. Hey man, I want to buy this. Let me put something down on paper for you. Okay, we better hurry before these other guys buy the car. Oh, hey, I want to do an offer too. Let me do an offer. Oh, okay, let's put something down on paper. We're going to take all these offers that we got. We're going to take them to the sales manager, and we're going to let him decide which one he wants to take. Sales manager looks at all the offers. That marketing scam worked. We really fooled those buyers. See, I told you that this would work. I told you that this scam is one of the best ones in the used car industry. We put a sticker on the car that is such an unbelievable price. Well, of course, we won't even sell the car for this cheap price. We couldn't sell it for this. It'd be a lot. But because we put that price on it, everybody's going to quit looking at the Camry, and they're going to start looking at the Lexus. They're all going to put their offers in on it. And then, once we've got all these offers, we're going to go back and negotiate with the person we think will pay us the highest price for this Lexus. And if they pay us enough money that they pay us what the Lexus is worth, we'll sell it to them. But if we're really lucky, they'll put in a big enough offer that they're going to actually overpay for the Lexus. This is illegal in the used car industry in Ontario, Jim. The OMVIC, Ontario Motor Vehicles Association, whatever it is. There's an act that says it is illegal to advertise a used car at a price a buyer cannot buy it for. Since it became illegal there, good old organized real estate picked up the reins. Good old organized real estate said, wow, that was a pretty sweet deal those used car dealers used to have. If we can get away with this, imagine how we're going to be able to jack up the price. You're watching it in real time. What's sad, Jim, is that there's guys like you, experienced journalists, guys who would question people when they just suspected there was something fishy. Guys like you, Jim, that today's news networks don't even hire. Guys like you who maybe deserve to be paid an extra 10, 15, 20% over a junior reporter that they would rather believe they can save money on. So they hire the junior person, leaving guys like you no longer working in journalism today in the way that you used to do. If you saw this going on right now, Jim, if you were a reporter in Vancouver and you found out that realtors were underlisting properties to fool consumers, to create bidding wars, are you telling me that you wouldn't be down there on the steps of your local government demanding answers from politicians why they're allowing this to go on, with the most expensive purchase people make in their lifetime versus, and they won't allow it, with a used car? Where is journalism today? Where are you? Why are guys like Jim who ask the tough questions? Because you folks don't hear all the tough questions he poses before we go live. Where are those guys? Because Jim, you didn't mean to do this, but you just exposed why so many myths about a housing market are believed. Reporters sense there's something wrong, but they don't have the skill to know how to ask the tough question that would get them the answers their readers need to hear.
Well, first of all, when you go to a news conference, you should have a list of 20 questions you want answered. That's a good start. I was taught that by Jim Robson, one of the world's best play-by-play announcers. He said, when you go to do an interview, what if you have a yup, nope guy? So have some material and go in with a natural sense of curiosity, and also don't just believe what they tell you. And if you don't believe it, question them about it. But they're not taught that, or if they are, they've ignored that lesson. But they won't hire people like me at broadcast colleges to teach people how to do proper journalism because it's not considered polite to ask tough questions anymore.
Hey, probably why they would never hire me to teach a real estate course. Probably the same thing. You know, not as if I'd ever apply, but I'm just saying probably why they wouldn't. Actually, I think, wait a second, didn't one of those real estate training systems block us from exposing the fraudulent statements they were making? Oh, I think that happened.
Yes, it does. Ross, thank you so much for answering our listener questions. And if you have any questions for Ross, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. Ross, thank you so much for being on the show.
Hey, thanks for having me on, Jim.
My guest has been Ross Kay, homeownership consultant at thewealthyhomeowner.ca. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.